Welcome. I'm Douglas White, the Director for the Center for Business and Economic Research at LSUS. And with me today is Dr. Timothy Vines. He's a professor of finance. And we're going to briefly discuss the GameStop events that have happened this week. And Dr. Vines is going to talk a little bit about short selling, why people do it, and give you an understanding of what's the underlying financial driver of everything that's going on. Before we really start this discussion, I want to stress that, first of all, any opinions that are offered here are the opinions of us, not LSUS, just our opinions, and also that nothing you take here should be considered any kind of financial advice. If you're gonna invest in options, if you're gonna short or invest in stocks, call a professional. Don't necessarily listen to us talking about this on the internet. So with that said, let's start. Obviously, the big news of the week that has captured not just social media, but the newscast and newspapers has been what's going on with GameStop. If you haven't been following along, GameStop is a not small is maybe not the right word, but a retail business that sells video games and buys used video games, usually based in a mall or strip mall of some sort. And it's been a relatively boring business for the last year to 2 years. Its stock price has basically hovered around January 10th a year ago, it's $5.43. If you go back 2 years, it's pretty similar price. The stock hasn't really done a whole lot. Then lo and behold, this week, all of a sudden, it jumped from around $10 to about $18 on January 8th. And then by January 25th, it was up to $76, $77, and it closed today at $325. So obviously, when you talk about stocks, if you take our econ classes or our finance classes, we talk about the fundamentals driving stock prices. Well, obviously the fundamentals of GameStop haven't changed in 3 days to drive the price from, 18 to 77 to 325, and it had gotten as high as 400 and something at one point this week. So the question is, what's going on? So what we're seeing going on is that basically that on Wall Street, a bunch of hedge funds had decided to short the GameStop stock. And what happened was there's this Reddit message board called Wall Street Bets that basically grouped a bunch of retail investors together and said, hey, everybody, let's buy $1,000 of GameStop stock on this day at this time. And what happened was that they did. And so basically they put these hedge funds, these billion dollar hedge funds, into what's called a short squeeze. And so what happened is then they got caught, and this has become more than a finance story. It's also become a little guy versus the big guy, the non-elite versus the elite. And also, if you go back as far as the bailouts in 2008, Main Street versus Wall Street. So I was talking with some friends, and a lot of my friends were like, oh, I didn't know you could short, or how does one go about shorting? So I thought a great discussion here would be to bring in a finance professor to actually explain the finances behind what's going on. So Tim, I'll turn it over to you. If you could briefly talk about, what is shorting a stock? How does someone go about it? Why does somebody do it? And then talk a little bit about a short squeeze.
Be glad to do that, Doug. Thanks you for having me. In general, we think of the market as a place where you have millions of different investors that are trying to find ways to save their money. They want to buy these financial assets so that they can generate fair rates of return that are appropriate for the risk that they're taking. So what we normally see is that from time to time, a stock is considered overvalued. In other words, the price is too high. The normal reaction from the typical investor when a stock price is too high would be, well, this stock is not providing the appropriate risk return trade-off, so I should sell it. And as more and more investors begin to agree with that opinion, That would drive the stock price down, raise the expected return, because there's nothing fundamental that's happened at the company that's changing the expected cash flows it's providing to the owners. So that the market driving the price down raises the expected return. The opposite situation is when it's undervalued. If people think it's somehow a bargain, then they'll start to buy it, and that drives the price up, lowering the expected return to what's a fair level. So it's normal for somebody who holds a stock to sell it if they think it's priced too high, and it's normal for somebody to want to buy a stock if they think that it's priced too low. But what we have here is a little bit of a different situation. The hedge funds that you were talking about, they're very specialized investment firms that create portfolios for large private investors and other hedge funds. Okay, so they'll take a position, and because they only have a few investors that are presumed by law to be more sophisticated than the typical saver is, they can create some strange positions either at the request of the investors, or they can just create it on their own and market it to these large sophisticated investors. So they don't have to follow the same kind of regulations that a mutual fund or an insurance company or some other institution that people indirectly invest through. A short sale is a way that you can take advantage of your belief that a certain asset is overpriced, even when you don't actually own it. You can pay a fee to some investment service firm, some financial services firm. They will go out and borrow the stock on your behalf and provide it to you. So you don't actually own it, but you have paid a fee to use that stock for a certain period of time. And then you can take that stock that you borrowed and you can sell it. So you're short selling it. You don't really own it, but you can use it to generate cash flow from a sale that you can then take and invest in some other thing until your contract is up, and then you have to go back to the market and repurchase the asset to pay back, to provide it back to the entity that loaned it to you. In general, if you're good at identifying the asset that was priced too high, the expectation is that you can buy it back at a lower price than you initially received from it when you borrowed it and sold it. So that's a short sale. You're borrowing the stock from somebody who owns it. You're agreeing to provide it back. Some financial intermediary is earning a fee for helping match you up with somebody who owned it. Because GameStop is in an industry that's undergoing a lot of changes, people don't really go buy video games anymore. They can just download it straight onto their gaming system. So just like a lot of other industries, GameStop is probably viewed negatively in terms of expectation in the future because they're still kind of doing things the old-fashioned way. At one point in time, enough people had short sold it that it's quite possible that the actual physical act of selling it at the onset of the short position could have actually put additional downward pressure on the stock. Okay, so we're expecting it to go down, or somebody's expecting it to go down. If enough people agree with you and there's enough short sellers, that actually causes it to begin going down. That's the way the market works. It doesn't really wait for the future to get here. If a predominance of the expectations believe a certain thing is going to happen, the market reacts to it now. To me, that's a good market. That's a market that is reacting to information and we don't have to actually wait to see the situation resolved. It's a little bit riskier though when you do that as a short seller, because you might be in the minority and you actually might be wrong. So you might end up having to buy it back at a higher price than you sold it for when you initially borrowed it. A short squeeze is when people see the price going down, either for natural economic reasons or because there's a large short selling interest in that asset, and they decide, either because they're contrarians or because they disagree with the expectation of the short sellers, they decide that it's now underpriced instead of overpriced. And so they begin to buy it. And the actual act of these short squeezers, the ones that are coming in after the short sellers and taking advantage of price movements, you know, they might turn out to be right, and their activity causes the price to go back up. Now, 10 years ago, just wasn't that big a deal. You would see short squeezes every once in a while. This is not really anything new. But because of the advent of technology and the ability of a lot of different kinds of people to trade in these new kinds of vehicles, instead of just, you know, calling a stockbroker, it seems that, and because of social media commentary, like you were talking about, it seems that in this case, the squeezers are vastly outmanning the short sellers in terms of how much money they're willing to put into it. Okay, so neither the initial weakness caused by short sellers or the subsequent incredible rise are due to true underlying economic fundamental factors. It's all due to market mechanisms and the overreaction that's being caused by all of the publicity. I'd like to point out, I'm not an expert. Believe it or not, I'm a finance professor. I don't watch financial news all day. But it's not just GameStop. The people at Reddit and the news and some other trading platforms are experiencing less pronounced but similar kinds of activities in a number of firms that are in what most people would consider declining industries.
All right, so that brings me up, or allows me to ask a good question. As you said, it's not just GameStop that they've gone after. There's been some movement with AMC and Bed Bath & Beyond and BlackBerry, as well as some others. But one of the reasons they say that they targeted the GameStop was that when you looked at the number of shares that were shorted, it was somewhere around 120%, 130% of all outstanding shares were shorted, meaning that they had sold short more shares than existed in the company. I thought that was against the rules. I thought that was naked shorting, and that in order to short a stock, you actually had to physically borrow it. Can you talk about that a little bit?
Well, it's possible that that could have happened because some of the short selling might have been happening in non-traditional ways. We have a lot of regulation of our traditional brick and mortar brokerage houses, and even some of the older discount brokers that were predominantly online entities. But you know, there's been a whole rash of new companies created to take advantage of this idea that, you know, you don't have to call your stockbroker to do something. You can just do it yourself. I'm not sure the regulation that provides a limit on the number of different kinds of positions that you're allowed to create. We ultimately don't know who the real short sellers were in the beginning, and we certainly don't know who the short squeezers are. they would tend to be even less well known. We know the companies that are facilitating those trades, but there's no mechanism for all the different companies to check with each other before they institute these short sales.
All
So
right.
it's
So,
quite possible that so many different people got interested in it and nobody knew what other companies were doing. And there's no regulatory system set up to keep track of that.
all right. Well, that brings up the question then, uh, when you talk about things like short selling and other derivatives that are maybe related to this, that, Warren Buffett once called derivatives financial weapons of mass destruction. You've seen talk about, some of the brokerages started limiting trades in these stocks, or they actually, I think, shut down trades on some of them on Thursday for
Yeah.
a while. So the question becomes, why do we have short selling? What's the benefit to the market from this? Why should we allow it? Should it be regulated more?
Yeah. Well, I mean, society benefits from having a well-functioning set of financial markets that respond to information. If we didn't have derivatives and we didn't have short selling, then the only kind of information that would be impacted in the value of something is going to be the actual trades in the asset. So derivatives and other methods are ways to bring in somebody who's willing to bet their own money that they have expectations about what's going to happen to an asset value. That's good for the market. The more information we have, the more people we have putting up their 2 cents worth to determine what we think is going to happen, the better the chances are that market levels can reach the fair price and the fair rate of return. Anything that restricts trading, anything that restricts the free flow of information is going to make the markets less efficient. The markets are less likely to be able to find a fair rate of return. Now, if there's so much information so fast that volatility is increased, that also decreases the chance that we can reach the fair rate of return. So there are regulations, both governmental and agreements by the actual markets themselves, that if we get too much of a price movement, we're going to stop trading. If you don't do what you agreed to do when you became traded on our exchange, we're going to suspend trading. Okay, and the SEC, if a company lies on financial disclosures and that's determined and things like that, they can shut down trading for as many as 10 days. Okay, so on the one hand, it's good to have more information, but if you go too far the other direction, if you get too much volatility, then that's bad as well. So we're always kind of walking a tightrope between getting as much information as we can so that prices adjust to appropriate levels versus not having enough information and not allowing trading. You got to always stay somewhere in the middle. And I think that the degree to which GameStop was short sold, and certainly the reaction of the squeeze players, I think that was completely unanticipated. And I think some of these new trading platforms were not financially secure enough to actually follow through on the mechanics of executing all the trades that their customers were asking. So the ones that are suspending trading, they're trying to keep from having to shut their doors and close down altogether. To the extent that violates whatever agreement they had with their customers, then there's going to be lawsuits about that. And they're certainly going to lose customers over this, but that might not be a bad thing. Maybe the next batch that comes along, or the current trading platforms, they're going to make sure now that they're more secure and they're more able to facilitate the orders their customers are giving.
All right, so I guess one last question. It seems the only way for this to end is for either the short sellers to prevail and be able to hold out long enough that the prices go back towards that more fundamental price, or for the short sellers to give up, close out their positions. But then, you know, if you're the people putting the squeeze on, you haven't made any money, right? Unless you actually cash out those positions. So it seems like the only way that this ends is with the stock price basically going back to where it was, say, 2 or 3 weeks ago, back to that, you know, somewhere between $5 and $18. So basically, I guess a few people are going to make some money or a lot of money, but a lot of people are going to lose a whole lot of money. Is that
Yeah.
basically how these
Well,
things play out?
the short sellers that saw the writing on the wall and reversed their positions early enough, they're going to lose less money than the ones that kind of started whining in the media and complaining about what was going on. I don't have much sympathy for them because they should have realized they were taking a risky position in the first place. I mean, they were betting, like you said, without any real skin in the game about what was going to happen. And so they're going to take a loss.
And a bet that has no loss limit, right? So if you short,
That's right.
you can
That's
lose
right.
an unlimited amount of money.
What's unfortunate is that some of the squeezers are going to lose out too. I mean, for today, for platforms to be refusing to allow new long positions in some of these stocks that are in question, that means there's still people out there that are trying to buy it. Okay, it's 400% more than it was, and you still have people trying to buy it. Anybody that would buy it at this point, acknowledging your
Right.
disclosure about investment advice, I mean, it would be irrational for them to expect that it would continue to go up. Okay, so I think some squeezers are going to lose money. The squeezers that closed out first and went ahead and sold what they had bought, you know, they might end up making some money. And I'm sure that there's probably some more sophisticated people doing this than what you hear about in the media. It's not
Right.
all it's not all teenage boys, you know, sitting at their mama's house doing this. There's some big money players. They're probably out of it already, and the rest of it is just residual excitement over, oh boy, look at what we did. So I kind of feel bad for them because they took some questionable advice. They jumped in for the fun of it, and they're going to lose some money.
All right, I guess I do have one more question. So we've been talking about the financial side of this, the people, for lack of a better term, playing in the stock market. What about the actual company? Does an event like this have any actual impact on the company that's going through this short squeeze?
It could. I think that a lot of companies these days are routinely providing part of the compensation for their employees through equity-based payments, equity-based compensation. They're giving them stock options. They're giving them shares of stock. They're allowing them to purchase stock at discount prices. So some of the managers and employees of GameStop, to the extent that they had participated in these equity-based compensation plans, you know, they might have got a nice little bonus out of this, depending on how long they stayed in. Most finance professors like me, most pointy-headed academics, will tell you that the way to invest is to identify the risk return trade-off level that lets you meet some of your financial goals, but still be able to sleep at night. Both the short sellers and the squeezers are taking a very risky position. There's no reason, there's nothing that's changed at GameStop except for possibly the fact that some of the employees say, you know, this is crazy. I'm selling off my equity now because I don't think it can continue. But ultimately, there's no reason that this should affect a company that it's occurring associated with, unless the managers make the terrible decision of starting to participate in the movements. You know, companies can buy their own shares.
Right.
So hopefully we didn't see anything like that going on. GameStop should be focused on, you know, how can we adapt to the new way that people are buying movies and video games? You know, they shouldn't be worried about temporary fluctuations in their stock price.
All right. Is there anything else you want to add or want to say about this issue?
No, I think everybody should save money. I think that you ought to keep enough money to handle 6 months to a year of income disruption in something relatively liquid that you can get to until you find a new source of income. And then the rest, you ought to seriously consider how willing you are to take risks. And you ought to hire a professional to help you find the collection of assets that's going to best meet your risk preferences. That's the only advice I have.
All right.
The rest of this is just fun to watch.
Right. All right. Well, thanks for joining me today to talk about this, and hopefully that if you're watching at home, then you at least learn something. And if you ever decide you want to short a stock, you at least now know the risk involved and what it requires to do that. So thanks for joining me today, Dr. Vines.
Thanks for having me, Doug.
You're welcome.